Let's get back now to what's top of mind for investors this morning, that January inflation print. Let's dive into it with John Hancock, investment management co-chief investment strategist, Emily Roland. Emily, it is great to see you here. You know, I have to admit, I'm having a hard time trying to figure out what to make of this report, because on the one hand, I think investors have decided, they're prompted by the Fed, that these inflation numbers are going to start to slow this year. So how much should we consider this report?
Yeah, I think the market's having a similarly hard time trying to digest the report as well. We saw two-year treasuries bouncing off the news, now looking flat, S&P 500 futures pointing to a higher open, but it's going to be a long day to figure out how the market digest the information. You know, I think it's important not to overemphasize one data point, but, you know, seeing CPI come in line with expectations, that shelter component is absolutely critical here. The rise in shelter inflation accounted for over half of the rise in total CPI. So we know that shelter, rents, housing, we know that's a sticky component of inflation. That's got to come down here over the next several months in order for the Fed to pivot as the market would like to see. So for now, we think that this gives the Fed fodder to continue to raise interest rates, probably another 225 basis points here in March and in May, and then they likely pause to see what happens next.
So how quickly, from your perspective, is the kind of environment for the U.S. consumer shifting?
Yeah, the U.S. consumer right now is on fairly solid footing. And of course, tomorrow we get another data point, likely another increase here in retail sales. So what we're seeing across the consumer is that right now their purchasing power is actually going up a little bit, considering the fact that inflationary pressures are coming down. So real purchasing power has increased and the employment market remains really strong. We're seeing the lowest unemployment rate, of course, in over 50 years. So the consumer is on fairly solid footing now, but we do expect that to change. Consumers are contending with more layoffs. We're starting to see that. It hasn't filtered through to the jobless data yet, but it likely will. We're seeing consumers dealing with an incredibly high cost of interest, credit card rates over 20%, auto loans at the highest rate in decades. And at some point, consumers are going to do the math here and decide that it's probably not worth it to engage in credit. So we do expect to see a slowdown there. But for now, the consumer is doing all right.
Emily, if you're going to get signs of disinflation, as you are seeing a little bit in this CPI report, does that tech trade deserve to come back here in the market?
Yeah, so we have seen a really tight relationship between interest rates and longer duration assets like technology. So I think if you did see a meaningful decline in rates here, tech would be one sector that benefits from that. But we look at technology as actually not being a terrible place to be, even in a choppy interest rate environment. A lot of these tech companies are very high quality. Quality is a factor we really like in this market. It means having a great balance sheet, lots of cash on their balance sheet, more durable profitability, a limited need to tap the capital markets in order to grow. So just like the consumer, businesses, we want to look for businesses that don't need to engage in debt at this part of the cycle. And tech is frankly the poster child for that. And I'm not talking about your unprofitable growth at any price type tech companies. I'm talking about your classic S&P 500 tech sector. We also like value, but I wouldn't abandon tech and growth stocks at this point in the cycle.
Perhaps just for my own clarification, what would you define or kind of qualify as a meaningful decline in rates?
Yeah, so I mean, we look to the leading economic indicators to help us understand the likely direction of rates from here. And right now, the leading indicators are kind of screaming at us that a recession is likely to unfold potentially in the back half of 2023. We're at negative 6% year over year right now. And typically when the leading indicators decline, bond yields fall. Remember that investors tend to risk to lean into safer assets if they believe that economic growth prospects are decelerating. You're already starting to see a little bit of that coming down from the highs of over 4% on the 10-year Treasury back in October. So we do expect the entire yield curve to shift down as the bond market reprices for recession. You look over the last few cycles, the last few recessions, the 10-year Treasury yield fell on average 3% during each one of those periods. So we could actually see a similar decline here from the highs at the depth of the recession. It's going to take some time. Yields tend to be pretty choppy in these late cycle environments. They wouldn't go wildly overweight duration yet, but we do think that there's a big opportunity to embrace fixed income in 2023.
Emily, it's interesting to hear you so pessimistic here, because I feel like the sort of consensus tone has been shifting a little bit away from that scenario. Is it because maybe people aren't watching leading economic indicators as closely, or what do you think is folks are missing right now, maybe?
Yeah, and Julie, by the way, it's not very much fun to be pessimistic. I don't love talking this way, but we rely heavily on cycle analysis in our work, and everything is telling us that, it's not looking great. You've got the yield curve inverted to the tune of 80 plus basis points. Got the leading indicators telling us that recession is likely. You've got, the senior loan officer survey indicating that credit conditions are tightening. But at the same time, investors are cheering this idea that there's a light at the end of the tunnel as far as the Fed pausing. And there's always a kind of pivot party at the end of every cycle where investors recognize that inflationary pressures are falling. They look to the end of the tightening cycle as something to celebrate. The challenge is they typically underestimate the lagged impact of Fed tightening. And we think that that's exactly what's going on in this environment. Look, equity markets are telling you there's pretty much nothing wrong. We're seeing cyclical assets near all-time highs. We're seeing, a broad sort of risk-on environment here. We're seeing high-yield bond spreads kind of barely budging above 4%. The VIX has fallen. So calm has definitely taken over the markets, but we think it's a little bit early here to call the all clear.
On a positive note, Emily, it's Valentine's Day, so happy Valentine's Day to all. I, for one, am looking forward to having the chocolate I bought myself later. Very excited. John Hancock, Investment Management, Co-Chief Investment Strategist. Emily, Roland, always good to see you. We'll talk to you soon.